Rohit Srivastava joins us this morning to help us understand what to make of the numbers that we saw in Q3, Rohit. And I want to first begin with the banking story. And we've seen a sort of contrast between both HDFC Bank and ICICI Bank. And if you look at HDFC Bank, we saw a net profit grow by almost 12%. But in the case of ICICI Bank, we saw the net profit actually come down about 4% or so. So overall, this seems to be something which is very unique to the bank itself and not the sector when you talk about ICICI Bank. And that's something which is visible even in the price action this morning, isn't it?
So it's unfortunate what you actually see when we see price action of ICICI Bank, especially over a period of time. Banking stocks like this one typically are highly correlated to the bank index. But over the last 3 to 5 months, I have seen it break away from what Bank Nifty was doing. In other words, the ICICI Bank stock is actually down over the last quarter or more, while Bank Nifty actually made it to an all-time high in the month of December. So this divergence was concerning to start with, that, why is it diverging? It did reach a very, very important support, which is why we've seen it bounce back over the last, few weeks. But the numbers are really not adding up, and they actually, indicate why we've seen this underperformance. So hope really would be that going forward, now that the market's already corrected, or rather the stock is already corrected, that things improve. We are not still seeing a bearish reversal from the recent bounce back, but it does put you on watch as far as the performance of ICICI is concerned. HDFC Bank, on the other hand, while it did do a little better, has been a little more aligned. But over the last few weeks, it too has, fallen back and stopped performing. So basically, what you're seeing is that smaller private banks, the likes of AU Small Finance or IDFC, is where the money has been, a lot of the short-term money has been chasing. And you've actually seen the big ones from Kotak, HDFC to ICICI lag behind and underperform. And there's no change in that as yet. So not really a good sign for the large banks.
Okay, so not a good sign for the large banks, but even if you look at the large banks, at least in the price action this morning, there is some divergence visible, perhaps awaiting some results. But Axis Bank is up about 2%, and ICICI, like we've seen, is of course in a downward spiral this morning, down about 2.75%. But despite HDFC Bank posting fairly decent, one would say, at least the net income also growing about 6.4% or so. We are saying that even HDFC Bank is in the negative territory in early trade. Why are we seeing that, Rohit?
Yeah, so like I said, it's happening across not just ICICI, HDFC, Kotak. These are the weak spots. Axis has held out this time. A year back, it used to be the opposite, where ICICI was holding out against Axis. So there is a divergence. I can't really pinpoint to the reason, except that markets just don't want, they're just not betting on the big banks that much, and are really betting on the smaller names. That's the clear pattern that we see underlying.
All right. Talk to us now about Reliance Industries. Again, we saw results come out for Reliance Industries last week. And again, this is one stock which has missed its guidance target, at least, even though we've seen that the revenue did increase almost to 3 lakh crore rupees, up about 10% or so. And the net profit also up about 1.6%. But net profit up just 1.6%, perhaps not in line with expectations of investors. Where do you see the action on Reliance from here on?
I think there's further downside. The break we've seen today, falling below 1450, is setting us up for a potential further slide towards maybe 1320. That is what I'm anticipating. It may not happen right away, but probably see it eventually go there. So it looks like a weak trend, and that's a major large cap stock which almost made a double bottom in the at the start of the year, because on the 5th of January it was back at the prices that we had seen only last year in July. And then from there we are seeing it sell off again. It's also been in the midst of all the news flow related to the oil and Russia trade, so that also has not helped. But definitely with earnings not coming in, it continues to put the stock under pressure.
Right, so pressure there for Reliance Industries as well. However, it's not just the oil story. In fact, what held well for Reliance Industries was the revenue coming from the telecom space. So one was still anticipating, Rohit, that there could be potentially some clearer announcement on the demerger of Reliance Jio from the mothership, but no real timeline and no real direction given to that as well. Do you think it is time that the demerger goes through? Because if telecom is where the money seems to be, then potentially the investors should enjoy the upside of that and not really get bogged down by all the volatility that we see in the oil prices?
So surely the telecom space is interesting because now you have left with a couple of big players, and they have a stronger share in the market. But when will they unlock that value for investors remains a question mark. It's usually when the markets are in good shape that you've actually seen Reliance do that. If you look at all their previous IPOs, they usually come out at times when markets are in good condition.
Right.
So definitely they would want to get good value when sentiment is much better than it is right now.
Right.
So they may just wait for the right timing.
Right. Okay. So timing is critical, and potentially when markets are in an upswing, when the stock is back above maybe those 2,500 odd levels, which is when we saw JFS, the Geo Financial Services, split out, could be potentially the right time for Reliance Industries. Meanwhile, I want to shift focus to the IT space, and the IT space also has been a mixed bag of numbers, hasn't it, Rohit? We saw TCS not living up to expectations. We saw Infosys pretty much hitting the ball out of the park, and now we are seeing Wipro also reflecting a growth of just about 0.2% or so in profits. Overall, the IT story has been fairly a mixed bag, if one can call it. Is there some sort of a guidance that one should keep in mind for IT investors at this stage? Should they just let go of their IT holdings for the time being and wait for the situation, for the story, especially on the US front, also to stabilize, and perhaps also see some announcements, more robust announcements on the AI front before dabbling back into IT stocks?
So it's been my view for the large cap IT that they're going to underperform as far as long term investing is concerned. There was a short term trade which has sort of played out. Most of the IT stocks have bounced back. I don't know how much more upside is there in the short term, but moment we take a 1 or 2 year view, then the large cap IT stocks which are growing earnings only in single digits don't really make sense at these values, and can easily come under pressure. I mean, the only positive angle ends up being that you're getting a weak currency, or maybe they end up getting some part of the AI trade. But so far, if numbers are as long as numbers are in single digits, that's not where it's happening. So the outperformance has mostly come from the second line or mid cap IT stocks over the last several years. That might remain somewhat the focus, but you would have to be very, very careful. So I wouldn't be overexposed to IT. In fact, we rarely cover that segment, and generally it's an avoid from an investment standpoint.
All right, avoid IT from an investment standpoint. And well, if you look at the numbers on the screen today, that definitely seems to be the case, as Wipro is down about 8.5% or so already in trade. Infosys also, I think investors raking in those profits. Infosys is down about 1%. Now, in the small and mid cap space, while you mentioned that you potentially don't recommend IT stocks, but in case some people out there were to sort of, diversify their IT holdings or potentially sell, profit take on a good day, their large cap IT holdings and dabble into the mid cap space, are there certain names that you would have for them, Rohit, that they should consider?
Uh, so we've looked at LTIM Mindtree for a while.
Okay.
It's done relatively better than the rest of the pack. Was up on Friday as well. May have some more short-term upside, but again, I just hope that the sector headwinds don't hit it.
Yeah.
But yeah, that's one stock that has done better than the rest of the pack.
All right, so those are some of the names that you could potentially look at, but of course the sectoral headwinds could be the bigger issue. All right, let's move away from our sectoral focus, Rohit, and really talk about what is playing out in the world right now and what that means for Indian investors at large. And there was this narrative over the weekend when we saw US President Donald Trump announce the fresh tariffs on its NATO partners in Europe, and Europe also saying that perhaps the 15% tariff on US imports is going to be implemented. Now, overall, there was this commentary running at that point that potentially this could be reason enough for global investors to look at emerging markets and Asian markets, including India once again, given that the tariff war between US and Europe could potentially heat up. Do you agree with that theory? Do you think there could be a chance now that potentially with all that is playing out in the Arctic Circle, there could be a chance that potentially investors could find better returns in Asia and India could be a beneficiary of that?
Unfortunately, I don't think that might end up being the case, and I'll
Okay.
explain why.
Okay.
We've already seen significant outperformance in emerging markets, Asia, specifically Taiwan, Korea, where most of the money went because of either the AI trade or because there were trade deals that were earlier done with some of those countries. So we've already been through that part of the trade. Now, if we try to anticipate that more of that money will come to India, the problem is that when geopolitical risk, especially at a global level, gets heightened, then money would tend to move away from all markets simultaneously. So it's not that it will get reallocated, to one place or the other. And India is
If
still in a
money leaves all markets simultaneously, where does that money end up?
That's a good question. I could have said precious metals, but that
Gold,
trade is
silver?
also significantly, no, that trade is also significantly overdone.
Exactly.
So the problem really here is that first of all, it actually, where it actually goes back historically, at least in the last 15 years, is the bond market.
Right.
It's not there yet. We are still seeing bond prices weak, but risk off trades are typically when you see the dollar going up and the bond market going up simultaneously. Uh, for the last 2 weeks, we are seeing the dollar tick up a little bit, but the bond market is still not doing that. So it's not clearly signaled the risk off at a great stage. But the news is not helpful because geopolitical news of this nature, which affects everybody, relationships across the board, especially among the big countries, creates unfortunate uncertainty for trade in general. And this is something that's not going to go away. But if you look at the timelines that Donald Trump has said up to June for raising tariffs if Europe doesn't agree, it's going to remain a hanging sword for months and months to come. So it's not that we can say, okay, next week there'll be a crossover. Doesn't look like it's going to happen. Uh, so it's just unfortunate, that this has come up at a time when we've seen good performance across Asia and India has lagged behind, and it could actually slow down that entire or reverse that entire trend, and that's the real risk.
All right. So you're seeing we are not really seeing an uptake in bond buying as yet. We are seeing that perhaps even gold and silver continue to be more volatile and not as much inflow as one would expect. But some would also argue that in fact that is a story that I read in the Times of India also this morning, that a lot of investors now in fact going to jewelry shops, a lot of investors are looking at buying silver and not as much gold, even though jewelers say that gold overall is far more resilient and far more predictable in its rise. But do you see this sort of silver gold trade-off or coupling effect of commodity prices playing out for a little longer? Because we've seen 2025 had gone absolutely bonkers when it came to silver prices. Do you think silver, gold overall as an exposure is something that investors should look at adding to their portfolios?
So there's a timing and time horizon question over here.
Absolutely.
When you take a 3 or 4 year view, I can easily say that the gold and silver bull market might still continue.
Okay.
However, you must remember that during gold and silver bull markets, especially silver, because that is the one, like you said, people are chasing. During silver bull markets, silver, whenever it gets overbought, when it's moved up significantly in one direction, has often reacted to the extent of 30 to 40% on the way down before going up again. And this is a risk that people need to keep in mind. I mean, even if I go back to, say all the way to 2006, at one point of time, silver had moved up from $6 all the way to $15.
Yeah.
And then it dropped back to $9. That didn't end the bull market. It eventually went to 21, and 3-4 years later, it was at 47. But that kind of a sharp drop is something that you have to, patiently wait for. So right now, I would say the silver market is extremely overbought, extremely overdone from a trade perspective.
Okay.
If you want to invest in silver, probably wait for 2-3 months, let it pull back, and then you might get a better opportunity for the long-term, timing of it. If you're already holding, I mean, if you bought silver at $30, then it may not matter so much to you if you have a 3 to 5 year time horizon.
Right.
But if you're really buying fresh, then it's better to wait because entry points really matter a lot, and you don't want to be sitting on a big drawdown at the start of your investment journey in precious metals.
Absolutely. So you're saying this may not be the best time to enter the silver market, but if you're holding on to silver, then perhaps keep holding on to it. And a few corrections, price corrections may not really hurt your portfolio. Finally, before I let you go, Rohit, I also want to understand from you, given all that we are seeing in the world, all the turbulence, all the volatility, all the uncertainty, which we thought perhaps could end in 2025, but we see it's come back with a bang in 2026. Do you think of all the markets, the US equity market still continue to be at least a mature, stable bet for investors? Because if Indian markets are likely to continue to be dependent on a lot what the US is doing, does it make sense to park some money in the US equity side?
Again, that's a trade that has worked over the last 12 months.
Okay.
diversifying into precious metals or into US equities. A lot of, certain big investors did try to do that and may have worked. But going forward, it might not be as simple as a trade. When I look at the US, we're already seeing a lot of momentum divergences on, weekly charts, which are indicating that there could be a potential correction. And again, coming back to this geopolitical angle is not going to help the US as well. When you get this kind of an angle, it's like I lose, you lose. It's not like we all win together. So it's not like the US wins and Europe loses. It's, if Europe is at stake, and then US is also at stake. So it creates unfortunate uncertainty for, all markets together, which is why I would not really bet on the continuation of the US trade right away. I would want to really step back and, see what the currency and bond markets really do over the coming weeks. Do they really go into a risk-off trade or not? And that, I think, is a very, very important part of this entire equation.
All right. I'm just looking at, at the charts when I compare them, Rohit, the US NASDAQ 100, for example, if I compare them for returns that it has given over a one-year period, in fact, some of those numbers are astonishing. Google is up about 70% in a one-year period. Nvidia is up about 34% or so in a one-year period. And stocks of Apple, Microsoft are still pretty much, giving a similar 7% odd return or so. But do you think the kind of rally that Nvidia and Alphabet have seen is something that that is likely to continue in the year ahead as well? Because we know AI is not going anywhere from here.
So I would say I'm still studying the situation. If I just look at the US market, I've already said that I should be open to some kind of downside risk before, considering how much upside may still be there in the AI and, tech, business trade. So it's going to be a little tricky. I think rather wait and see whether you can get better value in some of these names just because of the geopolitical risk that is beginning to develop. So for completely different reasons, apart from the business that we are seeing in AI, we might see better prices available at which we can get a better entry. So I think it's better to just wait out rather than try and anticipate that how good the returns are going to be in the next year.
All right. Well, let's leave it at that. Rohit Srivastava, as always, a pleasure having you here with us on News9. And thank you so much for all the input that you shared, which is going to benefit our investors watching the show. Thank you so much for your time.